Hey everyone, and welcome back to the channel. Today, we're tackling a topic that affects almost everyone at some point: debt. If you feel like you're juggling more debt than you used to, you are definitely not alone. A recent report from Experian showed that the average American is now paying over $1,200 a month to their creditors. For some, that's manageable. But for many others, it puts a serious strain on their budget, making it tough to keep up with bills, rent, and even groceries. Whether you're thinking about a personal loan to consolidate that debt, or maybe you need to replace a major appliance that just gave up on you, there's one key number that lenders will look at very closely: your debt-to-income ratio, or DTI. This little number plays a huge role in whether you'll get approved for that loan. So, what exactly is this DTI, and why do lenders care so much about it? Your DTI is basically a percentage that shows how much of your monthly gross income, your income before taxes are taken out, goes toward paying off your debts. Now, there are two types, but for personal loans, lenders focus on what's called your back-end DTI. This includes all of your debt payments. We're talking student loans, car payments, credit card minimums, everything. This is different from a front-end DTI, which usually just looks at your housing costs. Lenders use your back-end DTI to get a quick snapshot of your financial health. If that percentage is too high, it signals to them that you might be stretched too thin financially and could struggle to afford another monthly payment. Let's break it down with an example. Imagine two people, both earning $5,000 a month before taxes. The first person has a DTI of 35%. This means they pay $1,750 each month towards their debts. That leaves them with $3,250 for all other life expenses like food, utilities, and savings. Now, the second person has a DTI of 50%. They're paying $2,500 towards their debt, leaving them with only $2,500 for everything else. From a lender's perspective, even if that second person has a great credit score, their high debt burden makes them a riskier borrower. It's very possible their loan application would be denied because there's less wiggle room in their budget. Okay, so how do you figure out your own DTI? It's actually a pretty simple calculation, and knowing it can save you a lot of time and potential disappointment. First, you need to add up all your monthly debt payments. Go through your credit card statements, your bank account, and your credit report. Tally up every single minimum payment you make each month. Again, this includes car loans, student loans, personal loans, and minimum payments on all your credit cards. Second, determine your gross monthly income. This is your total pay before any taxes or deductions are taken out. You can find this on a recent pay stub if your income varies from month to month because you're a freelancer or work on commission. Just look at your bank statements for the last few months. Add up the deposits, and calculate a monthly average. Third, divide your total monthly debt payments by your gross monthly income. For instance, if your total debt payments are $1,350 and your gross income is $5,000, you divide $1,350 by 5,000, which gives you 0.27. Finally, multiply that result by 100 to turn it into a percentage. So, 0.27 times 100 is 27. Your DTI is 27%. It's that easy. Knowing this number empowers you to see your finances the way a lender does. Now, let's talk about what lenders are actually looking for. While your DTI is a critical piece of the puzzle, it's not the only thing they consider. They'll also look at your credit score, your employment history, and why you want the loan in the first place. But your DTI is that quick check to see if you can even afford a new loan payment. Generally speaking, for a personal loan, you'll want your DTI to be below 50%. However, many lenders are much stricter than that. Some might cap it at 43% or even lower. The key takeaway here is, the lower your DTI, the better. A lower DTI not only increases your chances of getting approved, but also helps you qualify for a more competitive interest rate, which will save you money in the long run. So, what if you calculate your DTI and it's higher than you'd like? Don't worry, you're not stuck. There are concrete steps you can take to improve it. The most effective strategy is to pay down your debt. I know, it's easier said than done, but even small extra payments can make a big difference over time. Focus on paying more than the minimum on your highest interest debts first. That's the debt avalanche method. Or you could try the debt snowball method, where you pay off your smallest debts first to get some quick wins and build momentum. Either way, reducing your total debt is the most direct way to lower your DTI. Another powerful option is to increase your income. Could you ask for a raise at work? Is it time to look for a higher paying job? Maybe you could pick up a side hustle, like freelancing or driving for a rideshare service. Even renting out a spare room can boost your income. More income with the same amount of debt automatically lowers your DTI. A third option to consider is refinancing or consolidating your existing debt. You might be able to get a new loan with a lower interest rate or a longer repayment term, which would reduce your monthly payments. Just be cautious with this approach. The goal is to improve your financial situation, not just to free up cash so you can take on even more debt. But what if your DTI is too high to get a personal loan right now, and you need money urgently? You still have some alternatives. One option is to apply for a secured loan. Unlike a regular personal loan, a secured loan is backed by collateral, like your car or a savings account. If you can't make the payments, the lender can take the collateral to cover their loss. This makes it less risky for the lender, so they might approve you even with a higher DTI. Another route is to add a co-signer or co-borrower to your application. If you have a friend or family member with a good credit score and a low DTI who is willing to sign with you, it can significantly improve your chances. Just remember, this is a huge responsibility for them. If you default, they are legally obligated to repay the entire loan. You could also simply try applying for a smaller loan amount. The bigger the loan, the higher the monthly payment. By requesting less money, your proposed new payment will be smaller, which might just be enough to fit within the lender's DTI limits and get you approved. Finally, and this is really important, if you feel like your debt is becoming unmanageable, it might be time to pause and seek professional help. A nonprofit credit counselor can be an incredible resource. They can work with you to create a realistic budget, develop a debt management plan, and negotiate with your creditors. You can find accredited agencies through the National Foundation for Credit Counseling, or nfcc.org. Taking control of your debt is a marathon, not a sprint, and there's no shame in getting a coach to help you along the way. So, to recap, your DTI is a vital metric that lenders use to gauge your ability to handle new debt. Aiming for a DTI below 40% is a great goal, but the lower, the better. By paying down debt, increasing your income, or exploring alternatives, you can put yourself in a much stronger position to achieve your financial goals. Thanks so much for watching. I hope this breakdown was helpful for you. If you got some value from this video, please give it a thumbs up. And do you forget to subscribe for more content on managing your money and building a better financial future. Let me know in the comments if you have any questions about DTI or personal loans. See you in the next one.